I see it says in my notes here, expect things to worsen over the next few weeks. Gosh, I just don't need that. Why?
None of us need that, my friend.
Yeah.
So when you look at the sell-off on Monday, every single risk, every single concern, every single headwind that you could attribute that to will intensify. Inflation will rise dramatically higher from here. The supply chains are broken into 2022. There's backup at the ports, there's backup in the warehouses, there's limited trucking with elevating rates at all of those levels. Container prices have gone 400 and 500% above last year to Europe and the U.S. Add to that the labor market isn't seeing the supply of labor replenish in the way that the Fed had hoped. And so we looked at the JOLTS. There was 11 million jobs, but there's only about 8.7 million workers looking for work. And so even a robust job number tomorrow, 500, 600,000, only puts but a small dent. And so we're going to see CPI of 6% this year. We're going to see PCE of 5% this year. That's not priced in. And so whether it's inflation, whether it's broken supply chains, whether it's even the debt ceiling, which we'll be revisiting 4 weeks from now, every single concern will intensify.
So why is the market today taking a chill pill and moving higher? I mean, is this just a temporary tonic because they reached some agreement on not bringing the hammer down on the debt limit until December?
I think so, and I think if you look at the yields tell the story. The yields are still rising. The yields know that this is but a temporary reprieve, and that all of the structural issues that cause folks like me to stay on the sidelines a bit here, they still exist and they will intensify. So this was a relief rally that we could expect, but it's temporary.
It's really if I'm going to infer from what you're saying, that this is not a time to buy. This is a time to wait for a better time to buy.
That's exactly right. Where I have to add here, I'm looking at sectors that are insulated from some of these concerns, that are insulated from rising wage costs, that are insulated or can pass on raw material or other types of inflation. And there are a few sectors that offer that. Energy offers that. They pass everything on to the consumer in the energy industry. So I'd look at some natural gas levered, I'd look at some big integrated, I'd look at some infrastructure there. Financials. The large diversifieds have shown that they don't need a more favorable net interest margin environment to show growth. It'll help, but we've seen this year that they don't actually need that. The Morgan Stanleys, the JP Morgans, that they can show growth on the back of their capital markets, their trading, their advisory business.